Good evening. So we are now on income tax for corporations. We will discuss how corporations are being taxed in accordance with the train law. So this is different from the taxation of individuals because we are imposing taxes on large businesses because a corporation is presumed to be bigger than ordinary business entities. So let's define corporation in accordance with the new corporation code. So a corporation is an artificial being created by operations of law, having the right of succession and the powers, attributes, and properties expressly authorized by the law or incident to its existence. So when you say artificial being, a corporation is just like a human being. It so happened that a corporation is a lifeless being. When you say artificial being, it is a juridical person, an artificial person having a name, having an official registration, but the difference of this corporation as compared to the human being is that a corporation is created by operations of law. When you say operations of law, we are referring to the corporation code. So, under the corporation, it has the right of succession, meaning to say the owners may transfer ownership to his or her successors. The powers and attributes and properties expressly authorized by the law or incident to its existence. That means all the powers and attributes of the owners of the corporation is transferable to their respective successors. So under the tax code, the term corporation shall include partnerships, joint stock companies, joint accounts, associations or insurance companies, and mutual fund companies. So it is not limited to the corporation itself, because if we will follow the corporation code, when you say corporation, it is the form of business organization. But for tax purposes, when you hear the word corporation, it shall also include partnerships. Partnership, actually, when we talk of a law, partnership is governed by a separate law. It is governed by the law on partnership, and the corporation is governed by the law on corporation. If we will strictly define partnership as far as the law is concerned, it is different from the corporation. But for tax purposes, partnership is also classified as corporation, meaning to say partnership will be given or will be imposed the same tax rate. If the corporation was given a tax rate of 30%, partnership will also be given a tax rate of 30%. And that also includes joint stock companies, joint accounts, association. When we say association, we are referring to the different profit-oriented associations or insurance companies and mutual fund companies. So, these are the different definition of a corporation for tax purposes, but the exception to the rule are the professional partnerships and joint venture. When you say professional partnerships, they are not classified as corporation. These professional partnerships are formed by group of professionals, example, certified public accountants, a group of engineers, group of lawyers, group of medical practitioners. They are considered professional partnerships. So they are not taxed in accordance with a tax rate applicable to corporations. When you say joint venture, there are two corporate entities that joined forces to undertake a specific project, and that joint venture will not be considered as corporation in this particular topic. So let's enumerate the tax-exempt corporations. So, if you know taxation, you must know the entities exempted from taxation. And these are the corporations wherein the corresponding tax rates cannot be applied because they are exempted in accordance with the law. The number one exempted is the labor agricultural organizations not organized for profits. Labor organizations, example, the Trade Union Congress of the Philippines, the Kilusang Mayu Uno, agricultural organizations, examples, kilusan ng mga magsasakang Pilipino. They are organizations, but the purpose is not for profit. The purpose is not to gain profit, and that is the reason why the law exempts them from taxation. Another one, the mutual savings bank not having a capital stock represented by shares, and cooperative banks without capital stocks. These banks and cooperative entities are exempted from taxation because the objective is not to gain profit. The objective of the mutual savings bank is to accumulate fund to help the members. The cooperative banks do the same. They have different members, they have numerous members, but the objective actually is not to earn profit but to help the members by providing financial assistance. That is why mutual savings bank and cooperative banks are exempted from taxation. Next, we have beneficiary society order or association operating for the exclusive benefit of the members, such as fraternal organizations. Fraternal organizations are familiar to everybody. These are the fraternity. The objective of every fraternal organization is not to earn profit, but actually to promote brotherhood among the members. At the same time, they are helping some charitable institutions. They are also involved in some charity activities. That is why fraternal organizations are exempted from taxation. And then we have cemetery owned and operated exclusively for the benefit of its members. Everybody is familiar with private cemeteries like Manila Memorial Park and other cemeteries like Eternal Gardens, etc. They are all exempted from taxation because the objective actually is not to gain profit, but to operate a certain place which will be given to the departed ones. That is why cemetery are exempted from taxation. And also the business league and chamber of commerce are exempted. As I have said, the objective of this organization is not to earn profit, but rather to help the members of the Chamber of Commerce, example of which are the Philippine Chamber of Commerce, the Filipino-Chinese Chamber of Commerce. The objective of this organization is to help the member improve the business operations in this country. And then we have the civic league or organizations not organized for profit but operated exclusively for the promotion of social welfare. We have numerous civic league organization in the Philippines. They are promoting social welfare. They help the needy. They are helping the poorest among the poor. So the objective actually is not to gain profit, but to help other people. That is why civic league or organizations are exempted from taxation. And of course, we have the non-stock, non-profit, educational institution. Actually, our university, La Consolacion University Philippines, is a non-stock, non-profit educational institution. Why? Because the objective of our university is not to gain profit, but to promote the ideals and spirituality of the institution, and to help students, especially those who cannot afford to pay high tuition fee. So our institution is a typical example of a non-stock, non-profit educational institution which is exempted from taxation. Next, we have government educational institution. Example, the Bulacan State University, Polytechnic University of the Philippines, University of the Philippines, all of them are government educational institution, meaning they are owned by the government and the government cannot tax itself. That is why these educational institutions are exempted from taxation. Another one, farmers or other mutual typhoon or fire insurance company. So the insurance companies which is intended to help the farmers are exempted from taxation because their objective actually is to help, not to earn profit. And the last one, the farmers, fruit growers. Our country is an agricultural country. Our government since time immemorial is supporting the agricultural business. And this is the reason why farmers, fruit growers are exempted from taxation. Now, let's discuss the corporate income tax rates on regular income. When you say corporate income tax rates, this is the rates to be applied to corporations as defined in the tax code. If you will still remember the previous slide that I discussed, partnerships are also considered corporation for tax purposes. So this is now the corporate income tax rates. We have to classify them into three: the domestic corporation, resident foreign corporation, non-resident foreign corporation. So the first one is the regular corporate income tax or RCIT. So when we say regular corporate income tax, that is the regular tax rate being applied to a corporation. So the tax rate is 30%. If your company is a domestic corporation, the net income will be multiplied by 30%. And what is the basis? Within and without. Meaning to say all the income of a domestic corporation, whether derived here in the Philippines, whether derived outside the Philippines, are subject to 30% income tax rate for corporations. And what is MCIT? Domestic corporation is subject to MCIT. MCIT stands for Minimum Corporate Income Tax Rate, and that is 2% of gross income within or without. Later on, I will discuss how MCIT is being applied to a corporation. And the basis of MCIT is 2% of gross income within or without. And that is for a domestic corporation. Or you have the second option. If you do not want to avail of the regular corporate income tax, you have the second option. And that option is the gross income tax. This is optional. And the tax rate is 15%. What is the basis? Gross income within and without. That means the 15% tax rate will be applied on the gross income of the domestic corporation earned within or outside the Philippines. So how can you compare number 2 with number 1? Under number 1, the rate is 30% to be multiplied by the net income. While under number 2, the gross income tax 15% shall be multiplied with the gross income, within and without. So that is the difference between the two. So if you are a domestic corporation, you have two options. The first option is the regular corporate income tax, or RCIT, plus the MCIT, or the option number 2 is the gross income, which is 15%. The basis of the first option is the net income within and without, meaning income derived within and outside the Philippines, while the tax rate for option number 2 is 15% of gross income derived within and outside the Philippines. So, if your company is a resident foreign corporation, the income tax rate is also 30% of net income, but net income within the Philippines only. That is the difference between a domestic corporation and a resident corporation. A domestic corporation is taxable on income derived within and outside the Philippines, while resident foreign corporation is taxable on net income derived within the Philippines only. And also, the resident foreign corporation can also avail of the 2% of gross income on income derived within the Philippines only. Just like the domestic corporation, the resident foreign corporation has the second option, and that is the 15% of gross income derived within the Philippines only. Next, if you are a non-resident foreign corporation, a non-resident foreign corporation is a corporation organized outside the Philippines. The office actually is located outside the Philippines, but they may have some business undertaking here in the Philippines. That is why they also earn money here in the Philippines. So if they earn money here in the Philippines, the money that they earn is subject to tax, and that is 30% of the gross income derived within the Philippines only. But the 2% gross income is not applicable to non-resident foreign corporation. And also the second option, the 15% of gross income is not applicable to non-resident corporation. So in taxation, especially in this topic, when you say gross income tax, that is applicable starting on the 4th year of operations immediately following the taxable year in which such corporation commenced its business. The tax due is the higher between the RCIT and MCIT. Let me explain. So, the gross income tax rate is 15% of the gross income tax rate is 15% of the gross income, and that is applicable immediately following the taxable year on the 4th year of operations. If your corporation started to operate 2020, when is the 4th year? 2020 is the first year, the second year is 2021, the third year is 2022, the fourth year is 2023, meaning to say the gross income tax rate is applicable on 2023 gross income. So if you will avail of the second option of gross income tax, that is applicable only on the fourth year of your operations. But if you will compute the regular corporate income tax rate, that is option number 1, please compare the result with the MCIT or the minimum corporate income tax rate. The tax due is whichever is higher between the two. If the RCIT is greater than the MCIT, then the corporation must pay the RCIT. On the contrary, if MCIT is greater than the RCIT, the corporation must pay the MCIT. And MCIT stands for minimum corporate income tax. So let's have an illustrative problem. Assume the following data for HANA Corporation as of December 31, 2018. So the gross income in the Philippines of HANA Corporation is 975,000 pesos. The expenses incurred of HANA Corporation in the Philippines is 750,000 pesos, while the gross income coming from Malaysia of HANA Corporation is 770,000 pesos. The expenses incurred in Malaysia of HANA Corporation is 630,000 pesos, while the interest on bank deposits of this corporation is 25,000 pesos. Take note of these figures because this will be used in answering the questions in this problem. So the question is, determine the income tax due, assuming the corporation is a domestic corporation. Number 2, resident foreign corporation. And number 3, non-resident foreign corporation. So remember the question. We are asked to determine the income tax due, the income tax to be paid to the government, assuming HANA Corporation is a domestic or resident foreign or non-resident foreign. Here we can see the distinction between the domestic, resident foreign, and non-resident foreign, and I will also explain in detail the purpose of the MCIT of the minimum corporate income tax rate. So let's begin answering this problem. So here is the solution. Assuming HANA Corporation is a domestic corporation. So take note, in accordance with our discussion a while ago, if your company is a domestic corporation, it is taxable on all income derived within and outside the Philippines. So here you can see, we will include all income derived in the Philippines and Malaysia, as well as the expenses incurred within the Philippines and Malaysia. So the gross income earned by the corporation in the Philippines is 975,000 pesos, while the gross income earned in Malaysia is 770,000 pesos. Then we will deduct expenses incurred in the Philippines of 750,000 pesos and also expenses incurred in Malaysia of 630,000 pesos. Our taxable net income is 365,000 pesos because we deducted 750,000 and 630,000 from 975,000 and 770,000. So we will now apply the regular corporate income tax rate of 30% to taxable net income. Regular corporate income tax or RCIT When we say regular corporate income tax, we are referring to the flat rate of 30%. So, 30% multiplied by the taxable net income of 365,000, the income tax due to the government is 109,500 pesos. So, here you can see how we apply the RCIT or the regular corporate income tax to a domestic corporation. So that is the answer to question number 1. Let's proceed to question number 2. Assuming HANA Corporation is a resident foreign corporation. In accordance with our discussion, a resident foreign corporation is taxable only on income derived within the Philippines. So the income derived within the Philippines of HANA Corporation is 975,000 pesos, and then we will deduct the expenses incurred in the Philippines of 750,000 pesos. The taxable net income of this corporation is 225,000 pesos. And then we will now apply the regular corporate income tax rate of 30% to arrive at the income tax due of 67,500 pesos. So here we can see the difference of the tax to be paid by a resident foreign corporation as compared to the domestic corporation. Question number 3. Supposing HANA Corporation is a non-resident foreign corporation, let's compute for the corporate income tax. The gross income is within the Philippines only. That is 975,000. Take note, we will add interest on bank deposits of 25,000 pesos. And the total gross income is 1 million pesos. The question is, why in the previous computation we did not include interest on bank deposits of 25,000 pesos? Because if the taxpayer is a domestic corporation and resident foreign corporation, the interest on bank deposits is not subject to regular corporate income tax, but rather subject to the final tax of 20%. I will repeat. The reason why interest on bank deposits is not included in the computation of the taxable income of domestic corporation and resident foreign corporation is that interest on bank deposits of these two corporations are not subject to the regular corporate income tax rate, but rather subject to the 20% final tax rate. That is why, in this case, non-resident foreign corporations' interest on bank deposits is not subject to the 20% final tax, but rather subject to the regular corporate income tax. That is why it is added. So the total gross income of this non-resident foreign corporation is 1 million, and that is the time for us to apply the 30% regular corporate income tax rate, and the income tax due of this non-resident foreign corporation is 300,000 pesos. Now, let's explain MCIT or the minimum corporate income tax. Actually, the reason why MCIT was born is to impose taxes on those corporations who may have been intentionally reducing their net income. Because before the birth of MCIT, some corporations are making it appear that the taxable income is very small. they will add more deductions, they will add more expenses. In some instances, corporations with the negative bottom line or corporations which resulted to net loss are exempted from taxation. But by the introduction of the minimum corporate income tax, even if your corporation is suffering from losses, you will still pay taxes. And we call it minimum corporate income tax. Why will I pay taxes? Supposing I am a corporation, my operations resulted in a net loss, but still the government will ask me to pay taxes because the minimum corporate income tax is based on gross income, not on net income. The objective of minimum corporate income tax is to avoid or prevent tax evasion or tax avoidance. That is the purpose of the minimum corporate income tax. So, Revenue Regulations number 2-98 as amended by 12-2007 provides that a minimum corporate income tax of 2% of the gross income, take note, 2% of the gross income as of the end of the taxable year is imposed upon any domestic corporations and resident corporations beginning on the fourth taxable year, immediately following the taxable year in which such corporation commenced its business operations. So, when can you avail of the 2% minimum corporate income tax rate, or when will the government impose the 2% minimum corporate income tax rate that will be applicable beginning on the fourth taxable year immediately following the taxable year in which such corporation commenced its business operations. Meaning to say, if your corporation started operations in 2020, we will count. So, the 2% will be applied on 2023 because 2023 is the fourth taxable year. So, even if you incurred losses on the fourth taxable year, you will still pay taxes to the government because the basis of the 2% is the gross income. And there is no such thing as negative gross income. That is why even if you operations resulted to a net loss, you will be still liable to pay taxes to the government. You cannot avoid or prevent taxes by means of the minimum corporate income tax rate. So, MCIT shall impose whenever the corporation has zero taxable net income. Take note, 2% may be imposed or shall be imposed if the corporation has zero taxable net income. The corporation has negative taxable net income. If the taxable net income is zero or negative, that means you incurred loss. That means your MCIT shall be imposed to your company. Whenever the amount of MCIT is greater than the regular corporate income tax due from such corporation, hence, MCIT is always computed and compared to RCIT starting on the fourth year of operations. The higher amount should be the tax due. Meaning, even if you have a positive net income, the MCIT will be applied if MCIT is greater than the regular corporate income tax due from such corporation. And that is applicable on the fourth year of operations. I will repeat. According to this regulation, MCIT is applicable only if the corporation has zero taxable net income. That is correct. If you have zero taxable net income, the 2% will be applied to your gross income because there is no such thing as negative gross income. If your corporation has negative taxable net income, meaning it suffered from losses, the 2% MCIT shall likewise be applied based on the gross income. But even if your corporation has net income, meaning positive income, positive taxable net income, MCIT shall still be applicable if the computed MCIT is greater than the regular corporate income tax due from such corporation. We will apply this revenue regulation in our succeeding problem for you to fully understand how minimum corporate income tax is applied. And what is gross income? Let's define gross income because the minimum corporate income tax shall be imposed on the gross income of a corporation. This means gross sales less sales returns, discounts, allowances, and cost of goods sold in case of sales of goods, or gross receipts less sales returns, discounts, allowances, and cost of services, direct cost in case of sale of services. So here you can see how gross sales or gross income is computed, meaning there is no such thing as negative gross income. All gross income is positive. That is why whether you like it or not, even if you suffered from losses, you will pay taxes to the government in the form of 2% minimum corporate income tax. However, all income exempt from tax and income subject to final taxes shall be excluded in the determination of income for MCIT purposes. Meaning to say, if you have income derived which is considered exempted from tax, that should be excluded. If you have income subject to final tax, example, interest income that is subject to final tax, that should be included in the computation of the minimum corporate income tax. So let's proceed to the next problem. Assume the following data for HANA Corporation for the year 2018, and this is the 6th year of operation. Take note, 6th year of operation, meaning the minimum corporate income tax is already applicable in this corporation. So let's read. The gross income from the Philippines is 975,000. And expenses in the Philippines is 950,000. Before we proceed, there is a presumption that the HANA Corporation is a domestic corporation, and that is under question number 1. So, gross income from Malaysia is 700,000 pesos, expenses from Malaysia is 720,000 pesos, and interest in bank deposits of 25,000 pesos. So here is the question. Determine the income tax due assuming the corporation is a domestic corporation, resident foreign corporation, and non-resident foreign corporation. So let's now compute for the income tax for these different scenarios. So here is the computation. If HANA Corporation is a domestic corporation, here is the computation. The gross income from Philippines and Malaysia is 975,000 plus 700,000. That is 1,675,000 pesos. And then we will deduct the expenses from Philippines and Malaysia. That is 950,000 and 720,000. So that is 1,670,000 pesos. Therefore, the taxable net income is 5 million pesos. We will now apply the regular corporate income tax rate of 30%, and that is 1,500 pesos. So this is the computation of the regular corporate income tax. But the problem will not end here. We will compute for the minimum corporate income tax. Why? Because we will compare the minimum corporate income tax with the regular corporate income tax. And whichever is higher, that will be paid to the government. Whichever is higher will become the tax liability to the government. So here we will apply the 2% minimum corporate income tax because Hana Corporation is on the 6th year of operation. So let's compute. So the minimum corporate income tax is computed as follows. So the gross income from Philippines and Malaysia is 975,000 plus 700,000 pesos, or a total of 1,675,000 pesos. What is the ruling of the revenue regulation? Minimum corporate income tax is applicable for gross income of the corporation. So, 1,675,000 is the gross income of Hana Corporation. And we will multiply that by 2%, the minimum corporate income tax rate of 2%. That is why the minimum corporate income tax rate is 33,500. Question: how much is the tax due? We will compare the minimum corporate income tax rate of 33,500 to the regular corporate income tax rate which was computed in the previous slide, and whichever is higher, that will be the tax liability to the Philippine government. And in this case, the higher amount is the minimum corporate income tax of 33,500. That is why this is the tax payable to the Philippine government. And that is how we apply the minimum corporate income tax. Remember, even if you suffered from losses on the 4th year of operations, you will still pay taxes to the government because of the minimum corporate income tax. And on the 4th year of operations, even if your net income is positive, minimum corporate income tax shall still be applied because we will compare the MCIT with the RCIT. And whichever is higher, that will become the tax due or the tax payable to the Philippine government. Question number 2. The corporation is a resident foreign corporation. A resident foreign corporation is taxable only on income derived within the Philippines. So the gross income in the Philippines is 975,000 pesos. The expenses in the Philippines is 950,000 pesos. The taxable income therefore is 25,000 pesos. We will apply the regular corporate income tax rate of 30%. So the income tax due or income tax payable to the Philippine government is 7,500 pesos. Now, let's compute for the minimum corporate income tax rate. Why? Because we will compare this amount to the regular income tax to be paid to the government. So the MCIT computation is as follows. The gross income from the Philippines is 975,000, and that will be the basis in the computation of minimum corporate income tax of 2%. Therefore, the income tax due to the Philippine government is 19,500. Try to compare. The regular corporate income tax rate is 7,500, while the minimum corporate income tax is 19,500. Whichever is higher, that is the one that will become payable to the Philippine government. Therefore, the income tax payable to the government is the higher amount of 19,500 pesos. So here we can see how we apply the minimum corporate income tax even to a resident foreign corporation. Remember, whichever is higher, if MCIT is higher than the regular corporate income tax, we will choose the MCIT over RCIT. Next, if the corporation is a non-resident foreign corporation, here is the computation. Non-resident foreign corporation is taxable only on income derived within the Philippines only. So the gross income in the Philippines of this non-resident foreign corporation is 975,000. Again, we will add interest on bank deposits. Why? We did not include interest on bank deposits in the questions in the solutions 1 and 2. Because if your corporation is a domestic corporation and a resident foreign corporation, interest on bank deposits is subject to 20% final tax. It is not subject to the regular corporate income tax. But if your corporation is a non-resident foreign corporation, the interest on bank deposits should be included in the computation of the taxable income to compute for the regular corporate income tax. So the taxable income after adding the interest on bank deposits is 1 million pesos. Apply the tax rate of 30%. The tax due or tax payable to the Philippine government is 300,000 pesos. We will not compute for the minimum corporate income tax. Why? Because MCIT is not applicable to non-resident foreign corporation. Remember this. Minimum corporate income tax is not applicable to non-resident foreign corporation. So that ends our lecture on income tax for corporation. I hope you learned something. I hope you can apply this lesson in your future profession as finance managers, because finance managers must be proficient in income tax law, in other words, the train law or other law applicable to taxes, because tax planning is part of financial planning. Thank you very much and good evening.